Hello and welcome to our series of classes on financial institutions. This is class number 5, and in this class we are going to talk about mutual funds. That, of course, is one of the types of financial institutions. I want to start talking about mutual funds with a simple example. Imagine an individual investor. Imagine a small investor who is saving, well, let's say $500 per month. And that investor is putting away those savings with some brokerage account. And the small investor wants to invest those monthly savings into different assets, be that stocks, bonds, ETFs, whatever it is. If that investor looks at some share prices, say for example, that individual wants to buy some of Amazon shares, the investor will discover that each share goes at the price of over $1,900. Okay, how about another popular company, Google or Alphabet, which owns Google? Well, that goes for nearly $1,200 per share. How about this popular construction company, NVR? That's over $3,100 per share. Well, maybe that investor has heard about Warren Buffett and he wants to join his company by buying a share of that, which is Berkshire Hathaway, and becoming a part of that business, becoming an owner of some of that company's shares. In that case, the individual investor will discover that one share goes at the price of over $325,000 for Class A shares. So the monthly savings of only about $500 would not be enough to buy even one of any of these shares per month. Even if this investor saves up over several months to buy any of these shares, in that case, that is still not an ideal situation, because then the investor would only have one or two of these shares. And owning just one or two of the shares does not give much in the way of diversification. That's like holding all of your eggs in one basket. In this situation, what can this small individual investor do? Is the investor confined to only buying penny stocks, only buying, not necessarily penny stocks, but other companies with a share price considerably lower, much lower than $500? Well, that's not necessarily the case. This is where mutual funds are important. Basically, mutual funds are financial institutions that collect investments from many, as you see on this picture, from many small investors. These mutual funds collect the investments from all of these small investors by selling its shares to those small investors. So the small investors buy the shares of a mutual fund, which, let's say, are priced at prices considerably below $500. So in that way, the limited funds from all of these individual investors, you see the arrows are relatively thin, so those funds are limited, are flowing into the mutual funds as these investors buy the shares of those mutual funds. What the mutual funds do is they aggregate all of those funds from a lot of individual investors into larger flows of funds. You see the arrows here are much thicker, and those larger funds can then be used to buy different kinds of financial assets, be that different stocks, even at the price of $325,000 each, be that different bonds, which are also pretty expensive usually, or different money market instruments, which also have denominations of over $100,000 in case of, let's say, negotiable certificates of deposit. So mutual funds allow individual investors of small size to invest into those large denomination investments indirectly through the mutual fund. Since these financial instruments belong to the mutual fund and the mutual fund belongs to its shareholders, these shareholders, this crowd over here, actually also owns all of these financial instruments. Even if, as an individual investor, I buy only one share of this mutual fund, I will immediately own some small tiny bit, some small tiny percentage of whatever is owned by that mutual fund. So even with the small amount of money invested into the mutual fund, I will gain some diversification, as my funds will be spread very, very thinly across all of those different financial instruments. If you look at the popularity of mutual funds and the total amount of assets all mutual funds control or manage in the US, it has actually grown a lot over the last 40 to 50 years. Starting in, say, 1970, there were only 361 mutual funds in US controlling under 50 billion US dollars. 10 years later, that number of mutual funds grew to 564, which controlled nearly $135 billion. Fast forward another 10 years, there were over 3,000 mutual funds which controlled more than 1 trillion US dollars. In the year 2000, there were 8,155 mutual funds, or somewhere around that number, of course. During that whole year, that number might have changed. And in total, they controlled 7 trillion US dollars, only in the US. Just before the global financial crisis in 2007, number of mutual funds declined slightly, down to 8,026 mutual funds, which controlled still even more total amount of assets, which were around 12 trillion. And fast forward 10 years from then, in 2017, there were around 9,356 mutual funds controlling nearly 19 trillion US dollars. So clearly, the popularity has exploded and the total amount of funds managed by mutual funds have grown significantly as well. There must be a reason for this growing popularity of mutual funds, and partly that is due to all of the benefits that mutual funds provide to a small investor. And next we are going to look at those benefits.